Hey everyone, it is Evan here from the Trade Risk on Friday, March 6th, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and finish off looking at some sector analysis. So it was another very busy week, another historic week for markets, and less so about the equity markets this time around. The historic moves that we saw this week all had to do with fixed income markets or the bond credit markets, seeing some extraordinary moves there. And we spend most of our time in these videos looking at stocks and U.S. equity markets, but this is a week where we do want to especially highlight what's going on in the credit markets, because it is it is quite extraordinary in the sort of developments there, especially this week. So before we get into that, let's first sort of recap the ending numbers here for markets, for U.S. markets. You can see that on Friday, all of the major indices closed down about 1 to 2% on the session. They did close well off of lows, so we did get down about 3.5% or so, maybe closer to 4% at the lows on Friday, but we did get an aggressive rally into the close. We'll talk about that when we look at the charts, but you can see still firmly in red territory. 5-day change numbers starting to move green. That is basically, we had a historic week last week with the amount of selling and just the magnitude of the drop that we saw last week, that this market has basically just gone sideways, and that's good enough to turn some of these into green. And if we look at the major indices versus some of the key simple moving averages, we're below everything except for the Qs, still holding on to that 200 period simple moving average. Now, if we go down to sectors, you can see getting a little more of a split nature now. You can see that we have utilities, we have staples and healthcare, very defensive tone of the market, now firmly in the green over the past 5 days. Of course, they were not immune to the selling. They suffered big, oversold conditions and some aggressive selling last week as well, so kind of rebounding off those technical oversold conditions. But financials, transports, energy continuing their path lower this week. They did not stabilize. Those were the laggards on this week. In terms of major markets, it was VIX, so volatility still at the top of the list, followed by TLT with a massive 7.4% move, and gold rounding out the top three. On the downside, we had oil, we had the US dollar, and we had HYG, which is the high yield credit market instruments. So let's jump into the charts now. Let's take a look here of the price action. This is the weekly chart of the S&P 500 cash settled market. We always like to start our analysis here. And you can see that basically this week, we went absolutely nowhere. We closed pretty much identical to where we closed last week. Now, a couple of things to note, that we did still have a very large range this week. So from low to high, it was about 7.5% intra-week range. So that's pretty large. Of course, anything next to this candle here is going to look small because, we set a lot of records last week in just the magnitude and velocity of the selling. So this may not look as big as last week, but still a very large range for, a otherwise S&P 500 market that does not cover that much ground. We still have the ultimate lows here from Friday that are holding, which was approximately about just under 16% pullback off of the all-time highs. And if we want to sort of put on a couple of more levels, I'm not going to go too deep into this because we sort of framed out the market in our last weekly recap on last week's edition, and we talked about a lot of these levels. We kind of know some of the areas we should start to pay attention to if this market does roll over from here. We have some approximate pullback zones or retracement zones, or if you want to say bear market zones. We kind of know the percentages at some of these levels below us, but these white lines here really taken from sort of the monthly chart or the weekly time frame, the real kind of more significant pivot points to pay attention to. You can see 31.27 basically where we got to up the highs of this week. So that's a good reference point from us above. So those are some of the longer term levels we can start to pay attention to if, of course, we start to lose and we roll over from last Friday's lows. So right now, the damage is contained. And if we go to a daily chart now and we maybe clean things up a bit more, let's see, where is my... yeah, we'll go to this board here. So if we look here at the daily chart of the S&P 500, you can see, one of the things we tried asking last week was, whether or not a retest was necessary. We came to the conclusion that, of course, it was not a necessary event to unfold. We did not have to come down and retest, but I would say, of course, it's too early to say that this was, to say that this is, of course, a bottom at all, but to say that this was a retest here, I would put this in a retest category. The fact that we traded down to about 2,900 even, and, getting close to or approximately down to within a 1% range of last Friday's lows, I would say that this is potentially a retest that just occurred. Now, whether or not that holds, whether or not that's the only retest, that's, of course, something we cannot conclude in this video. We don't know, obviously, what's going to happen in the future. I wish I did. But we can be paying attention now to a follow-through to the upside day next week. So if we do get some immediate follow through to this reversal action here, that would be encouraging for the bulls to potentially hang their hat on some type of retest here, follow through to the upside. I think that would get some of the short-term traders and maybe even some of the longer-term or intermediate-term traders maybe starting to nibble or get a little more interest on the long side if there's a little more proof in here that prices have started to stabilize, and that is in fact, or that does in fact have potential to be a successful retest of last Friday's lows. So I think that's important to sort of just point out here, that if you're a short-term trader and you're looking at this action pretty acutely, then you may have had that, and we can look at some other markets after that. Sort of reinforces the point where maybe this was a successful retest. Now, the other kind of point I want to make here, 2 points, is that we did just have, throughout the course of this week, we had a almost 10% rally off of last Friday's lows. So, in terms of retracement, if you want to call it a dead cat bounce, maybe you don't believe in this market yet, whatever the case is, we still had nearly a 10% rally off of last Friday's lows. So, maybe you got, taken for surprise in this first initial downdraft, where I think many traders did, and for obvious reasons, I think that makes a lot of sense because of how aggressive the market relentlessly sold off. But if you did get caught in this and maybe you were stubborn, you didn't sell, or you held on to some stocks, sold some, then you had a chance with this 10% rebound here to potentially offload some of that risk into higher prices. So you had a chance to sort of get out here at higher prices, if you were quick. We didn't stay up here too long. It was basically 2 days worth of trading up over 3,100. If you had that chance, and that's great to lighten up. Of course, we rolled over hard into Thursday and Friday, and then of course Friday with a little bit of hope here into the end of the day. So all in all, basically just a very busy session. And the other comment I want to make on this action here is that with a VIX, which hit new highs, we got up to a 50, lower 50s, mid 50s in change here on Friday's session. That's good enough for highs or levels last seen in the financial crisis, so back in 2008. But even though we pulled off of those levels, we didn't close north of 50. We closed at 45. 45 is still an extraordinarily high number for the VIX. And basically what that's saying is that the normal for the S&P 500 is, in fact, these 3% moves on a daily basis, up and down in either direction. So they're not, they're not really extraordinary days anymore. They should be the normal. We should basically come in next week. If the VIX is holding above 45, we should anticipate that we're going to see 3% ranges in the S&P 500, and that is kind of our new normal right now. And if you haven't sort of reacted to that or adjusted to that, I think you quickly need to do so, especially if you're a newer trader that hasn't seen this type of movement. So 3% ranges, I think, as long as the VIX is holding north of 35.40. That should be sort of table stakes at this point, and that's what we should be expecting. And if that's uncomfortable for your trading style, of course, you need to adjust accordingly. So I definitely wanted to, so those were two things I want to talk about: the 10% bounce that we saw here intra-week, and the VIX up there, new 2008 highs. Let's get into credit markets, because I think this is interesting. I'm just going to use the 10-year yield as a proxy here. You could look just across the curve. It doesn't really matter what you want to pick. I think either way you can see just the historic, extraordinary move that we saw. So we're looking at the 10-year yields. Oftentimes you're seeing people, look at bonds, the actual bond funds like TLT, which tracks the underlying ETF that tracks the actual asset and has the yield of a 20-year plus bond. But in this case, we're looking at yields outright when we're looking here at the 10-year Treasury. Now, what you'll notice is that the speed at which we have fallen is absolutely breathtaking. And what's also important to note here, just to put it in context, is this really does dwarf the stock market in terms of capital flow in and out of the credit markets. So this is a really deep central part to basically the world economy here, and to see this type of move is something that we have never seen in the past. Even in 2008, you did not see such an aggressive fall in yields like we did back in 08, like we did in 2000, or really as far back as you can really go in terms of credit. So I think this is something obviously we can all think about and ponder about. It's the experiment we're all involved in. There's two ways to look at it. One, I mean, this is signaling some very doomsday dire times here for maybe equity markets of what's to come, and maybe we shouldn't be trusting this rally yet. Or you could look at it the other way and basically say, you know what, maybe this is the sort of capitulation period for this low interest environment that we've been in, or this essentially kind of like a blow off, to the credit markets that we've been in such a tightening period for 30 years, 35 years, going all the way back. So it's interesting. Nobody's going to really, we can all think about it. Nobody's going to really have any good guess. I think this is all new, uncharted territory. But the implications here, I think, are certainly going to be fun to watch, fun used loosely, going forward. So this here and what we saw in, you could look at your AGG bond fund, or if you want to look at TLT, is quite remarkable in the records that we set this week. And of course, the S&P 500 didn't really flinch this week, but it obviously reacted last week. And then you could ask yourself, do we have a second leg down? Again, we'll have to take it one day at a time. But definitely doing some homework there and looking at the credit markets, I think, are pretty interesting. Case study, do some research there if you haven't ever really explored what's going on there and the types of moves we saw. So that I will leave there. If we look at the other U.S. major markets, we get the Qs, which they're kind of faring best right now. They're still above a rising 200 SMA. Of course, they suffered pretty much the same magnitude fall the other week, about 17% to the downside, 16.5%. Of course, again, you can look at Friday's action here and potentially say, you know what, maybe this is, again, a retest here, or a failed attempt to take us back down to these lows. We reversed here, closed strongly. So again, getting follow through to the upside next week, I think, would be a good next step to try and stabilize these equity markets a little bit further, and to get some more confidence there in the bull side. IWM, if we skipped over that one, This is the small cap index. This did break to new lows on Friday. So notice it did not hold on to Monday's lows. Last Friday's lows. It broke lower, got down to about 17.23. That was the, at the lows here. It's basically the amount it has pulled back off of its 52-week highs. So we can see just a deeper pullback here in small cap stocks. They continue to sort of struggle here as they have been for quite some time. They did close again above last Friday's lows, so and closer towards the day's highs. So again, could be a potential save there, but they did undercut briefly last Friday's lows. So that's it. I think that's the bulk of it there. Again, 40 plus VIX. Protect yourself amongst all else. I think that's the most important thing. If these are new uncharted territories for you in terms of volatility, then take a step aside, dial back that risk, and just understand that ranges have really exploded here. So if you were taking 200 shares on an average trade, maybe you're taking 50 shares now. Of course, you want to probably think about it in terms of volatility and ATR and risk factor versus just share number, but I think you get the point. So let's jump into some other markets now. So we'll go to TLT, which we briefly talked about. Again, 7.38%. Actually didn't, let's see if we can put on a rate of change here, because I don't know if this is the largest 1 week. Let's see if we can go back, see how far we can go back. So not quite the largest 1 week move, but pretty darn close, and certainly in the top 5 or so weeks that we've seen going back into the financial crisis. Of course, we're quite lofty and extended here in the TLT. We've had a great move to the upside here, heavy volume coming in on Friday. So by all metrics you could throw on this is statistically sort of overbought and stretched. But of course, if this if the fear continues here in the market, then this is still going to be seen as a classic safety haven here, and capital is going to continue to flow like we have seen. So TLT, remarkable move, sitting certainly at the upper end of the Bollinger Band, above the Bollinger Band, and again, just quite the momentum move there. If we look at gold, you could see back to highs here. So we had that 1 week, this little fake out week here where we came down kind of engulfing to the downside the prior week. We came back and almost kind of checked back to the longer term trend, and now we have reversed again and closed 6% to the upside this week. So a very big move for gold, back to 52-week high, 52-week closing highs on the week, and back in its uptrend here. It is extended to the upside a bit, but certainly had a nice reset washout here just last week. If we look at silver, silver here also on the daily chart doing some recovery. It was up 4% this week. Of course, looks a lot different than gold, does not have the same uptrend momentum characteristics that gold does. So I like it a lot less here than say GLD. It has more to prove, but at least it is sort of holding on to this longer term support down there around 1550. Last but not least, if we look at energy markets, oil taking a really big dive here into the end of the week on Friday, down 9%, going back to multi-year lows now. If we go to a weekly chart of USO, you can see we're coming back down into sort of this 2016 abyss here. So technically is oversold, has had a very sharp sort of 2020 to the downside, essentially starting up here. We're down, almost over 30% on the year. So it's had a pretty extraordinary fall so far this year. And right now it still looks like risk is to the downside. And it does have, again, some oversold properties, but you have to be careful there. Some momentum divergence as well. So if you're very active and short-term and nimble, maybe there's some opportunity there. But again, you got to be careful. Natural gas did attempt here into the middle of the week to get back into this range. Did roll back over though. So again, still having difficulty, positive momentum divergence, but cannot stabilize in terms of price yet. So you're going to have to wait for more convincing sort of price action, I think, to get too excited here. So that's natural gas, that's commodities, that's all of our major markets. Let's take a quick peek now at sector performance. We'll look at the top best performing, worst performing. You can see utilities getting a good chunk of last week's sell-off in. So they sold off hard last week, despite being, generally seen as more of a safety rotational sector for the equity market. They did get sold off pretty hard last week, 11.5%. You can see they rebounded 8% and certainly closed much closer to the upper end of the range. Heavy volume coming in. So just from pure relative performance here, quite a nice recovery for utilities, nice stabilization there. Staples, pretty much the same thing, just a little bit less so. So it was 10% down last week, 6% rebound this week, closing much near the upper end of the range as well. And again, you can see 61.60 or so. That's where we found some resistance in second, third, or more like third and fourth quarter of 2019. So makes some sense that we're kind of closing right back at that level. But both of those sectors doing a pretty great job at rebounding lots of last week's pain. And third is healthcare XLV, which basically along the same lines here, really tough last week, rebounding the majority of it, and these are our initial sort of leaders right here back to the upside. On terms of downside, it's energy, which makes sense. We just looked at the USO chart. We know that energy is in a world of pain this week, so XLE continues to sell off. It's been selling off for quite some time. Again, oversold on lots of traditional metrics you can throw on it, but still makes it uniquely difficult to try and catch a bottom. Financials also following through to last week's selling, so we're seeing less stabilization here, and we're starting to lose some of this more significant level in here around this $26 area. This is a problem because there's really a lot of supply that traded hands and transacted around $26 or so. So if we're going to continue to cut through here and start falling below this band, then I think financials are going to be certainly in some tough tough waters ahead. Of course, with yields plummeting and banks lending out money, earning less on that lent, then this is certainly why we're seeing some of the reaction here and continued underperformance in financials. Last but not least, discretionary here, third worst performer on the week. Again, you can see, kind of looks like the SPY, though. Doesn't look a whole lot different. I mean, the one thing I will say is for discretionary, there's lots of, this is kind of a nice band of, consolidation that took place for about 6 months or so. So lots of supply traded hands. The longer we stay below this zone in here, I think the worse it looks for discretionary. So I got to be careful in this ETF, but third worst performer on the week. So better things to, I think, pay attention to, at least at this point. So that's it. That is the full recap. Lots going on, of course. I think we highlighted a lot of the risks in this market. So there's certainly opportunity, opportunity is certainly what we're all after. But again, I think it's more important to sort of highlight some of the risks out there, especially for the newer traders, to kind of get through this period and kind of take things one day at a time. So that's it for me. Thanks as always for tuning in and watching. You can subscribe on our YouTube channel or follow us at The Trade Risk. Have a great weekend, and we'll see you back here next week on Tuesday. Thanks.